Canadian National Railway, NYSE, CNI, stock fell 1.59%, as on April 27, 10:18 p.m. Coordinated Universal Time -4. Source: Google Finance, after the company cut its outlook for profit growth and cash flow for 2022, saying it expects costs to be significantly higher than it previously forecast as the price of fuel soars. The Montreal-based company said operating expenses increased 12% in the first quarter, partly because of the spike in fuel prices triggered by Russia's war in Ukraine. The fuel expense was up 44% as the company saw fuel prices significantly rising in the quarter, with WTI touching around $125 a bar. And on-highway diesel prices spiking up in March, up 27% versus February. Q1 adjusted operating ratio came in at 66.6%, which was 30 basis points higher than the same period last year. CNI generated free cash flow of $571 million for the quarter, up $31 million from last year, $32 million from last year. The increase was mainly from proceeds on the sale of non-core branch lines, which was partly offset by lower net cash from operating activities. The company delivered adjusted net income of nearly $925 million in Q1. CNI in the first quarter of FY22 has reported the adjusted earnings per share of $1.32, missing the analysts' estimates for the adjusted earnings per share of $1.38. The company had reported the adjusted revenue growth of 5% to $3.71 billion in the first quarter of FY22, beating the analysts' estimates for revenue of $3.67 billion. This is despite volumes on an RTM basis being down 8%. The volume drop did not come from demand, which remains strong, but was mostly driven by extreme winter conditions in January and February, continued supply chain challenges and a weaker Canadian grain crop. The company did experience significant volume increase in certain markets. This is due to U.S. grain shipments to the Gulf Coast for exports, Canadian coal from the new tech business, as well as 2 coal mines that reopened in late 2021. The company projects earnings per share growth of 15% to 20% on an adjusted basis. The previous target was 20%. Canadian National's new outlook for operating ratio is 60%, up from 57%. Canadian National also trimmed its guidance for free cash flow, saying it could come in as low as $3.7 billion, $2.9 billion, this year versus a previous target of $4 billion.